welcome to the Future Invest In. I'm excited to be on here with these three panelists. We've spent the morning talking about clean tech, going into the startup showcase in that last round. So founders talking about the nitty-gritty of their business and running that in the day-to-day. This next panel is going to focus on the future and be very forward-looking. We're lucky to have three very different panelists in terms of the industries that they're in. So we'll get kicked off and talk about the future of investing. So I want to start with Will. Guys, just go around, introduce yourselves, give the little sort of elevator pitch, and maybe share a little bit about your position on the future of investing, just like where you guys see it as a VC fund, that sort of thing, and then we'll get into some roundtable questions.
Good afternoon. I'm Will Derrick. I'm currently working for a company called Quake VC. We do generalist seed stage investing, and from Austin. And I think that for our business, one of the most impactful things in the past 2 years has been AI. You know, it's extremely hyped right now. We're seeing last year 50% of all VC money went to AI companies. And so what we think about a lot is kind of how that's going to land and what companies will end up being winners from that and what companies won't be, and then kind of how that will change the landscape of our investing going forward.
Thank you. Yeah, we're going to dive into all that.
All right. Hey, I'm Anthony. I'm CEO and founder at SeedLegals. We're a 160-person company based in London, now in New York, and it's a legal tech platform. So if you're a startup founder, instead of paying huge amounts of money to lawyers, you'd get on our platform and do everything to get investment ready, to safes, cap table, and a priced round for a lot less. About 50,000 startups in the UK are on our platform. So I talk to thousands of founders and more than half of all UK companies on the platform, and I'm looking to change that in the US. But because I talk to so many founders, I'm not here to pitch SeedLegals. I'm here to share the learnings I've got so you get there faster. And maybe the kickoff point from my side is that the standard problem is founders going to VCs too early. And VCs say, I love what you're doing, come back later, and you should be going to angels earlier. And I'm sure we'll get into a robust discussion on that.
Right on. Thanks, Anthony.
My name is Scott Hansen. I'm the former founder and CEO of a company called Island Brands, which I sold to private equity about a year ago. Have since started a company called Maverick Brands, which helps startups and growth stage companies raise capital online through equity crowdfunding, both Reg CF and Reg A+. In our personal journey as a founder, we raised $30 million, which helped scale Island Brands, and 7 of that was through Reg CF. We were pioneers in the space back in 2018, 2019, and now we are spending all of our time evangelizing how great this ecosystem is and how dynamic it is as we trudge into the future.
Right on. Well, thanks for teeing me up. These intro questions, we're going to focus on the future. Anthony, I want to start with you, both in terms of the UK perhaps being a little bit more forward-looking in some of the legislative landscape, right? But also in your experience applying tech to solve these problems and remove friction, right? When you look forward at the space, right, where do you see technology, and please talk about SeedLegals as well, right? Eliminating friction. Is it, are you excited about technology applications? Is it mostly AI? Is it the combination of those two? Tell us what you're excited about in your domain as you look forward.
So I used to think the UK was super liberal, and then I started reading Twitter, and I see, Elon saying Europe's a backwater. I've got to take issue with that. In our day-to-day life, there's zero friction from government, from legal in building our business. What I've observed in the UK, there's a very forward-looking legal infrastructure. We don't have to be a law firm. We can offer legal advice. In the US, it's a bit more difficult. The US also has got lots of states to keep things more interesting, right? So it's not just one country. You have to pick which state you're going to incorporate in. But what you want as a founder is you want to spend as close to 100% of your time building a product, because that's the only thing that's going to make you win. And all the time you spend on admin stuff be it taxes, legals, accounting, or whatever you want to minimize. And so that's what our goal is. And what we've seen is, my hypothesis is fundraising is kind of broken because you go to a lawyer and they create a Word document and they send it to another lawyer with the Word document and they go backwards and forwards and charge you $600 an hour to create. And at the end, statistically, you're going to close at exactly the same place as you kind of started, because funding rounds, when you do a lot of them, you see, certainly in the early stages, they're very formulaic. You're raising $1 million on a $5 million post-money cap safe and so on. And at this stage, the investor's going to get a board seat. At this stage, they're not. And if you're doing a crowd round, no one's going to get a board seat. So what we've seen over thousands of rounds is the standard patterns, and my goal is now to automate that. And of course, law firms have never wanted to change what they're doing, but now AI is forcing them to rethink that. And so, one of the things we're going to cover here today is how much AI do you have to be taken seriously as AI, and at what point will it be a negative in your pitch deck mentioning AI or not?
Right on. Anthony, thanks for that. It reminds me of a tidbit I heard recently. If it weren't for lawyers, we wouldn't need lawyers. So appreciate the problems that you're solving out there for that, taking friction out of the process. Will, for you, right? So you mentioned AI and what you all are seeing. Anthony touched on it a little bit, using technology to, make things move faster for founders so they can focus on building the product. For you all, I can imagine you're looking at AI both as an investment opportunity and also something that helps with OpEx internally as companies leverage AI. Share a little bit about that with us on either side of that coin.
Yeah, so we're seeing startups are able to be do more with less, right? If you have a sharp guy as your CTO, he can leverage AI to be much more efficient in this day and age than it used to be. It used to be teams of engineers creating software products, and now it can be much smaller teams. And from a CapEx, perspective, that's pretty attractive, and it kind of changes the need for funding. In terms of investing, our fund doesn't look heavily at AI. We're generalist, and sort of to piggyback off Anthony's comment, it can almost be a detractor if a company that we don't think where AI has a core portion of the business or product, it almost sounds like a distraction or something that they're putting in there to sound very sexy when at the end of the day they might not be that sexy. So I guess maybe that answers the question.
It certainly does. Thank you. Scott, for you, so you've been on both sides, right? So you've raised capital. Now you work with founders, helping them raise capital, deploy that capital. Have you seen shifts in the space recently? Was it brought about by AI? Was it brought about by the VC funding crunch that came out of these really high valuations that we saw? Just share a little bit about your experience and what you're seeing.
Yeah, I think the evolution of technology obviously has changed how we raise capital online. The proliferation of more structured walled gardens in whether it's Meta, LinkedIn, YouTube, those dollars that we spend are typically harder earned in those walled gardens. So getting outside of those channels where we're actually finding more success in nurturing the communities that we're working with, it's become more challenging, but it's also exciting because it's evolving to a place where I think we'll end up seeing some really exciting things in the future, including a lot of liquidity on blockchain.
Can I hop in with a
couple?
couple?
Please.
Two things. So, with AI in your business, I think there's sort of two areas that you might use it. One of them is for coding, and the other one is for outreach, customer support, and so on. So let me talk about these for a second. So I'd love to know from the audience who's using Cursor AI or one of the others for coding enhancement. All right, so a couple. So I'm always wondering, my team is got a great dev team, but I have to like push them with a stick to use more AI. And I keep wondering whether, when I look on Twitter, it's like, oh my God, I could have built my entire platform in a weekend instead of 7 years with 20 or 30 developers. So is it just marketing hype, or is it real? And I was at a panel a few minutes ago with the UK government AI thing with some unicorn AI companies, and I asked them the question, and I think they're all looking to use it, but later stage teams are not using it as much. So that's one thing. The second thing is using AI for customer support to create personas. So obviously you've got somebody here, I'm sure is like genuine. You're not going to replace the guy with AI. But
Not replacing me.
Exactly. But you can always recognize, so you see a lot of AI startups looking to do outbound marketing, LinkedIn, create 3D persona of you. But I think in the same way we've had a no filters moment, we're going to have a no AI moment in a whole lot of outbound outreach and so on. And so I'm also interested in discussing how much you're using that, as am I, or not, to replace what humans are doing.
Well, thanks for sharing that. We just had a team trip, so and something happened with the website. Well, the engineers were in the air, and somebody had to send it to me. It's been a while since I've played with HTML and CSS. It's great. I used Cursor. Problem solved. I looked like a hero. Yeah, so we're seeing a lot of companies.
Your team still have a job?
There was a reasonable excuse, yeah, and hopefully they're also using Cursor. It's a real cheat code. It's incredible. Anthony, to you, I wanted to talk to you about some of those biggest trends that founders should be paying attention to. Is that where you'd land that question? Should they be really focused on decreasing OpEx right now? Are there other technological shifts that you would tell them to focus on?
I think as a founder, sort of natively, when you look within, you're either going to be the next generation of the world's going to be completely different with AI, and you're going to rethink a problem in a completely different way, or you're sort of more traditional, but you're using AI to get there more efficiently. So in my business, my customers want to talk to a human. They don't want to, when they call and go, listen, my investor, I'm wanting to raise $1 million on a $5 million, valuation. My investor says it's a little high. I don't think they want a chatbot to go, yeah, no, that sounds great, try it a little low and see how it goes. They want to talk to an expert. So even though I've got a support team of 30 or 40 people, I want to use AI judiciously to help them, but without replacing them. But maybe I'm not thinking it through far enough and I need to go the next step. So, as the founder, you're always thinking, replace something completely in a really new way, or use it. I think the last thing from me is I look at the legal tech space, and there are tons of companies using AI for legal tech. So here's one thing that's really, really important to know, because it's going to kill many businesses, which is for you as a founder, you want like a 70% chance that your business is going to sell for $20 million in a few years' time. If you get home and, for an investor, they invest often like a poker game or a roulette game. They might want a 30x or 50x return on investment, knowing that 10% will succeed and 50% will fail completely. So if you get home and say, hey, honey, there's a 1% chance we'll be a unicorn and 99% chance we'll go bust, your partner's going to say, get a proper job. So when you are going to VCs, I think you should, or investors, you should be aware that for the investor, they might be investing in way more AI companies than your sector will support. And when I look at legal tech AI for law firms, I see 50 companies. I also talk to law firms, they're selecting like one. So recognizing that for an investor, it's worth pumping money into many companies doing the same thing, knowing that there'll be one winner. But for you, maybe you're better off talking to angel investors or crowd, to get your odds without having to be on this treadmill of you have to go faster and faster until you're dead or unicorn.
Thank you, Anthony. That made me think about capital formation, capital deployment. Scott, I want to ask you about capital formation, right? But capital deployment, talk to Will. When you guys are, thinking about investing in companies now, there was the IPO backlog recently. Markets have tanked a little bit now, more recently, unfortunately, right? prior to that, valuations were pretty inflated. What are you guys looking at right now? Are you hanging on to capital? Are you keeping it close to the vest before you deploy? Are you, doing that so you have some dry powder? What are you all thinking about right now in terms of the companies you're looking at and when to invest?
Yeah, in short, it is absolutely like a case-by-case basis. I think that there's always going to be winners out there and companies that you want to invest in immediately. But from the landscape, venture's been really tough the past 2 years, and it seems to be getting better. But I think it's created a shift where, as a VC, we're looking for more. We're looking for companies to have like a little bit more solid fundamentals, even at an early stage. We want efficient use of capital. We want founders to be thinking about how or maybe why they exit like early, and
feels understandable.
And I think that the days of money is free and scale at all costs, find a unicorn, they still exist in certain circles for sure. But I think a lot of VCs are taking a more disciplined approach and finding success with it.
Yeah, I appreciate that. I mean, slightly different end of the spectrum, but I believe some of the backstory with FTX was like they just didn't have a board of directors, and people would ask them about that, and FTX would tell them to pound sand, and everybody invested anyways. So slightly different time that we're in now. So I can see how that would make you all look back at fundamentals, right? There are winners out there, and I bet their fundamentals look good.
Yeah. Yeah, I mean, I think everyone gets like definitely a little starry-eyed if you see a pitch deck that looks really good, but you do want to like kind of go back to talking to the team and like analyze the founder. Founder fundamentals are so important. Is this person gritty? On the last panel, they talked about all the lows they went through, and like if your founder's not in it for the right reasons, then that investment, no matter how good the idea, might just fail because he quits or she quits.
Yeah, certainly. Scott, for you, in your experience, right, incredible success at Island Brands, right? I remember seeing all the collateral from the raise, that sort of thing.
People still stop me in the airport.
I'm sure, yeah.
I sprayed myself all over Meta.
Yeah. Scott had this incredible ad. He opened up the fridge in the beer aisle, and he was like kind of peeking down the barrel of it. So yeah, I'd stop you in the airport too, as a fan. For you right now, so you've raised retail capital before, you work with founders raising retail capital now, equity crowdfunding, or just raising online, right? What are some of the hurdles that you see for those founders now? Is it the investment landscape? Is it the ability to position themselves? Do retail investors want to invest right now in the current climate?
Well, we are seeing a shift, at least in the consumer product space, to a lot of investors looking at the wellness space, which there's a proliferation of a lot of investors looking for wellness-related products. But in terms of some of the challenges, AI is great for data deployment and trying to retarget audiences and trying to find those communities out there. But where we see a lot of challenges is where people are trying to use AI for the actual marketing piece. People are still just a lot smarter than that. And there's nothing that beats a founder that can provide their potential community a really great story with passion. That really is what we look for. We're in a fortunate situation where there's a lot of people looking for capital, and so we pick the companies that we work with. And one of the first things that we look for is the founder's passion. Can they articulate and communicate, what they're looking to do? Because ultimately, you're selling a dream that in large part will probably fail. And so, you want to be able to articulate that dream with passion and grow that community. The communities that are out there of the people that invest in these opportunities are really the gold. Like we don't focus on let's go get you capital. We focus on the messaging, raising the awareness, and building that community. The capital's the residue. If you do that successfully, the capital shows up.
Yeah, certainly. Well, I can imagine that some of the same, you talk about fundamentals in the deck, but, you're also working for, somebody who has the personality of that, the racehorse that's going to be the winner. Yeah,
the fundamentals at the stage we're looking at are pretty dubious. We have invested in companies that, on paper, they're not super good. But I think that you can always look at a founder, and after several meetings, you can start to assess, who is this person? Why are they doing what they're doing? And do I think they're going to bring some intangible to this company that's going to increase their chance of success? Is there like an arbitrage opportunity there? So yeah, with seed stage, of course, the fundamentals get wonky. But I think for series like A and beyond, it's a little bit more disciplined.
Anthony, please.
Yeah, just on the founder persona and pitching and so on, this is really vital because I talk to thousands of founders and, some of them jump out like, I want to invest in that. And you're always trying to figure out, as you talk to people yourselves, what's that little sort of intangible thing? It's that you kind of want to go on this ride with them because they focused on some big picture outcome with, they've kind of dialed it up to 11, but you still think they can get there. And the challenge is most founders are, if you know your Myers-Briggs profiles, they're INTJ or INTP. They're probably tech founders. They'd love, like I do, to sit at a computer and do emails late at night instead of talking to people. But you have to reinvent yourself, and you have to learn the art of the pitch. And that is going to be the difference between getting investment, getting people to join you in your team, and getting people to build, to go and buy your products. And until AI can replace you, no, it's not going to happen. Then that's the key skill to learn, and then to analyze. So when you go to pitch competitions, to go to pitch events and so on, and you'll see people pitching. And most cases, at the end of it, you have no idea what they pitched. And you want to start with something powerful. You want to explain the problem you're solving, and then you work from there. So, and I do webinars and so on that. My favorite one was a barrister in the UK, a criminal barrister who's now a pitch deck coach. Why a pitch deck coach? He said, well, years of being a criminal barrister, cases are hardly ever won or lost on the facts. It's always the storytelling, which is a bit worrying. But she now brings storytelling to pitch deck creation and to tell your story about the problem you solve. So that's the key thing to focus on.
Love that. Thanks, Anthony.
Don't let the facts get in the way of a good story.
Scott, for you, right, so you've had the success raising retail capital, sold to private equity, right? So you have that sort of view of the capital stack where it's, there's retail, there's institutional-based capital, right? Do you see a world where founders bypass traditional capital? Do you see them working in conjunction in the capital stack?
I hope so. I think that the democratization of capital is where we're headed. I've met with some other founders in the tokenization, universe and where blockchain sits. And I think that once we can create, standard liquidity for these opportunities, I think the world's going to open up, and I think we're closer to that than we realize. I mean, some of what we're doing right now, I think, is it's funny. People just don't know what they don't know, and I speak a lot about crowdfunding and trying to evangelize this for founders because I think it's such a tremendous opportunity to go find your people and get them to support you before you let the pariahs into your cap stack. The opportunity to be able to have your community support your efforts and grow that over multiple rounds, I think is where it's headed, and it's exciting. It really is.
That's great. Will, I can't imagine a world, I don't want to speak for you, but where you wouldn't want sort of an army of community members involved in a company who are, this grassroots support for them that is this retail investor, and being able to invest alongside that. Do you see any friction there?
Yeah, I mean, there's an issue, I think, if you, in some sort of retail investing model, like if you were crowdfunding a company, where, you need to be very clear, like, who gets a say in the direction of the company, right? Like, you don't want too many cooks in the kitchen. You don't want to be able to, like, hosting votes on the next decision of the company where everyone gets to, based on how much they invest, cast their vote on where you think it should go next. I think that crowdfunding is absolutely the right capital funding option for a lot of companies. VC is incredibly particular. We look for home runs. That's how this business model works, and the failure rate's pretty high, and there's really high barriers to entry, which I think are all negative things. So the idea that retail investors can get involved in supporting and then eventually seeing returns on companies they believe in and support is a great idea. But yeah, I think that you have to definitely be very clear on kind of the rules up front. And I will also add too, if you guys don't agree with this, I'll have an existential crisis. But VCs add value in some way to the companies they invest in. We like to think that us being on the team and part of the table can help companies survive and grow and achieve their goals. And I think if from a crowdfunding model, that might be a harder value proposition to come through.
Yeah, certainly. We've seen small examples of companies, an IP lawyer comes out of the woodwork. Yeah, should we have changed this format to a debate? We've seen IP lawyers kind of come out of the woodwork that are investors, and, they help them with patents and that sort of thing. But certainly at a larger level, Teague spoke about it earlier. GM is an investor in them now. That's a sort of strategic partner that's incredibly important to them, commercializing their technology, that sort of thing. So, I certainly see both worlds there. Anthony, please.
Yeah, literally sitting in the middle here. If you're looking for money, you sort of the spectrum, right? You can go to 1,000 people investing a few $100s each, or you can go to one person investing $1 million, or you can go in the middle, which is to angel investors, and get 20 people investing $50,000 or $20,000 each. And that's kind of the area that I focus on. But, when you think about what's best for you, I spoke to, interestingly, crowdfunding is a lot more popular in the UK, I think, than the US. And people, will flip between one and the other. So a friend of mine was doing data at one of the crowdfunding platforms, and one of his goals was to predict which crowdfunding rounds would be successful. And he said that the predictor was, do you have a big social media following? So it seems like if you can work the crowd in real life, you can work the crowd in a funding round. And also it's retail brands that people identify with, so it's often going to be microbrewery things and so on, whereas if you're doing some defense AI thing, your average investor putting in $10K or $500 isn't going to know about it. So what you want is you want to have a set of tools available that you can pick that's what's right for you. If you're raising $5 million, it's an awful lot of crowd folks and quite a few angels. So you're probably going to start with angel/crowd initially and then work to VC later. And the other one thing, by the way, I should mention is that if you have a VC, the VC is going to have investor consent rights and a board seat. If you have lots of angel investors, they're not going to have any board seat and they're not going to have any consent rights. So I quite like to have a spread population because you avoid a veto power from a VC. I should add, I've got Index Ventures as a VC in my Series A round. So when you get to the point, it's not something to avoid, it's something to embrace, but you can grow your business fast in the early stages by just reaching out to a retail or a smaller number of angels.
Certainly. In this last segment, I want to focus on the next 10 years, right? So looking way ahead here. This first question is for Scott and then Will. Scott, something that you see now that you think in 10 years founders or investors will look back on and think, hey, it's crazy we were doing it this way. Is it how they raise capital? Is it how they run their company in the absence of AI and using AI? What do you think about the future for companies there, whether it's founders or investors?
I think the proliferation of technology is going to allow us to see a faster route to market for these equity crowdfund. And I want to make a note that all VC, PE can add value, but it depends on the stage, right? Like when you're looking at a company and you talk to a founder, that founder has a dream. It's very personal to them. And in order for them to maintain that dream and control, equity crowdfunding allows for that. We had 9,000 people invest in our company, and they were championing us, and they were highly engaged. I think that'll never go away. I think that the proliferation of that will grow as it makes it easier technologies that make it easier to actually get on the platform and actually grow in that space. I think that, Rebecca's CEO of DealMaker was lobbying Congress last week, and if you haven't heard her testimony, Google it, look it up on YouTube. I mean, very powerful. And, the way I see it is that the future is going to be where Will and I are going to be locked in arms to help brands, grow at a certain stage, and then VC and PE comes in to help with, an accelerated exit. That's just, I see that happening. And when Rebecca talked about raising the caps and allowing for more synergy between the CF and the Reg A plus, going from 75 to 150 million, allowing institutional investors to come into those rounds. I think it's the combination of both that's really going to create, the future for founders to accelerate their dreams.
Love that. Will, for you, anything, 10 years from now, we're going to look back and say, hey, this is crazy? Are we going to have a, under 10-person team, unicorn? Are they the billion-dollar team because they did it with AI? What are your thoughts on the space?
I wouldn't bet against it. I think that in the next 10 years, kind of like to elaborate on what Scott's talking about, as a venture firm, we have investors as well, and we go out to institutions and endowments, and we ask for, big checks from companies and entities that can afford to give away millions of dollars with no liquidity for like 10 years, and it's really high risk. And that is why, venture has existed and how it's like, gotten so big. I could see in the next 10 years a situation where you have a fund that might look like a venture fund, but it gets its investment from a crowdsourced methodology. And so you have people who are believing in investors who believe in companies. And I think it is more of like a vehicle to just deploy capital in a different way. It kind of reminds me a little bit of how I think access to just general equities, the stock market has increased so much in the internet age. Now that we have things like Robinhood, I think that access to alternative investments could be sort of the next big wave.
Fascinating. Yeah, I'd love to see the different large language models duke it out on the investment space. It's like Llama from Facebook versus, ChatGPT sort of thing. Anthony, for you, you've done incredible work at SeedLegals, pioneering, legal tech in the space, make it easier, more transparent for founders and investors. Is there anything in the regulatory space that you see, needs to shift in order to unlock this next wave of growth?
I'm not sure there's going to be much. I mean, we all know that regulatory stuff moves glacially compared to everything else. So I don't think you're going to see much. I mean, there's some rules change. You can raise more with Reg CF from Crowd and a few things. But, most of your business is about finding customers and building a product. And everything else is just noise. So, if I get to say 10 years from now, we're all in the metaverse doing this panel session no, because the Texas beef barbecue, you can't get in the metaverse. So we're all going to be here still. Taste shit in the metaverse. But I think, to me, a key existential thing for a startup, for every one of us to think about is, how do we grow our business using AI? And once upon a time, it used to be a badge of honor. The more employees you had, the better you were. And that suddenly changed. And certainly my Twitter feed is filled with, people saying you can build the next unicorn on one person. I think that's all bullshit, because as soon as you've got a successful business, you add salespeople and you add others, because you go faster by having these other people. Plus, as a solo founder, you can't do taxes in 50 states and all this other stuff that needs to run the business. So you're going to have a larger business, but you're going to figure out how you can get there using AI to test it, validate it, scale, need fewer support and sales team members and so on, to get a leaner business so you don't need to raise as much, but also because your competitors are going to be doing the same thing.
Thank you for that. Quick aside, I owe some payroll tax in Idaho, and AI is not going to get that done for me. About to wrap here shortly. This is the last panel. Are there any questions from the crowd?
Well, I wanted to ask selfishly one question, and then I'll pass it to anyone, so think of your questions. So at EnergyX, we're obviously very bullish and have been quite successful raising capital from retail. I think we've raised close to $90 million from 30,000 investors. But 10 years ago, when I was in the startup landscape, the idea of raising money, $100, $500 at a time, was unfathomable, and also kind of had like a yucky stigma to it, right? Retail capital has come such a far way, but it still seems like there is some type of stigma in raising capital from retail investors. Like, it's not as prestigious as a venture capital firm. And I'm curious, each one of you probably has a different perspective, but why do we think that retail capital has such a bad rap, and what would need to change in order for that perception to change?
I can start. It might be just VC's gatekeeping and talking shit. I think that it's new. It's always pretty easy to criticize what's new, but it works. And when there's success stories start to come out about it, and people see it as a very good alternative, or an alternative that maybe fits their business better, and they have success with it, I see a world in which they coexist, and it's just two different options. One's not better, they just have trade-offs.
Once upon a time, the only way to get money was to borrow it from a bank. And then equity investing started, I think, largely in New York, and that's people would put money in. There were funds, and there was nothing else. So VC was the starting point. So then when crowdfunding and angel investors came along, I think people saw it as a second best. You couldn't raise from a fund, so you had to go to the crowd. But you should invert the narrative. There's nothing wrong with it. It's a new tool. So what you want is, without any embarrassment, you've got various tools you can use to grow your business. And if you are the kind of founder that can reach out to a crowd and tell a great story, you should use it. And if you've got an investor that, one of the things you might hear is, well, VCs don't like crowd on your cap table. I think that's nonsense, and I wouldn't want a VC that doesn't want that kind of thing on my cap table. So, my last round, I was thinking, should I go to VC or should I do a crowd round? I've got lots and lots of founders on our platform. I can just write to them saying we're raising. And we debated it. Eventually, it turned out that actually Index Ventures wrote a nice check, and I didn't need to. But I was flirting with it, and in retrospect, I kind of would have liked to do that. So see it as all options, and you don't need to be embarrassed about the one you take. Whatever you're doing, you want to put the least effort into finding the investment needed to get you to the next step.
I would agree with Will. I think some of the stigma comes from VC themselves. And just unknown. When we were raising capital and we were going to institutional route, everything they told me not to do, I did, and that was my North Star, which included doing the crowdfunding. But I think that there's this misnomer still, because there's not a lot of people that really know what it's about. When you talk about it, when you stop somebody on the street, they think it's like Kickstarter. There's still that misnomer. They just don't know what it is. So I think the stigma is just not knowing. But I will say the PE firm that ended up buying Island, they were like, what do we do with all these people? And I was like, you keep them. Because they're the ones that are running around buying the products. They're your biggest evangelists. And I'm proud that we were able to do what we did to get where we were, with that ecosystem. And we wouldn't have been able to do it without it, because consumer products are a heavy lift.
Open it up for questions. Who has a question we probably have 2 or 3 questions. Okay.
Hello, my name is Sotiris. It actually feels pretty nice not to be the startup founder pitching up on the stage, but asking the VC the questions, the other way around. So with AI, the main difference that we're seeing in startups now is we need to move a lot faster. What we needed 12 months before, now we have to accomplish in 2 months to remain first movers out there. So I feel like money is pretty easy right now to raise, but to move even faster, we need strategic investors. How does a VC will help me strategically to open more doors for me, to open maybe 3 more countries, and not just by getting money? So that's it.
I'll go first if I can. Yeah. So, when you go to a hotel or you go to rent an apartment and they go to show you how fantastic the lobby is and the bike racks, the more they sell the wonderful lobby, the shittier the room's going to be. And I think with VCs, the more they upsell how they're going to help you, the lower the valuation they're going to lowball you on. But the reality is, VCs mean well, but 2 or 3 funding rounds later, they've gotten bored and moved on. So that all the things they're promising they're going to help, of course you want your VC to evangelize you and talk about you any opportunity. But to rely on them doing a lot more than bringing money, I think is tough. So for me, I see an advisor as someone I pay money to, and when they stop giving me advice, I terminate it. And an investor is someone who gives me money, and I don't necessarily want to talk to them. I want to give them a good return on investment in a few years' time and kind of leave me alone to run the business. If they help and evangelize, that's awesome. But I know they're going to have done 5 more rounds, flirted with 5 more people in between, and gotten bored with me, and I should just expect that.
Thank you so much. That was a wonderful panel. This is a question for Scott. I'd love to hear more about your strategy for Island Brands. Clearly, you're a pioneer in this space. We'd love to hear more about what that success looked like and how you were able to accomplish it.
I'm sorry, Camille, one more time?
Your strategy for your Reg CF, what that looked like and how you were able to achieve success with crowdfunding.
Ours?
Yes.
Our personal one? Yeah, I think really for us, it boiled down to really cultivating the community early on. We had a really great engagement with the people that were buying our products. And then, boy, oh boy, I primed that pump. Like leading up to the Reg CF that we initially launched, people were like waiting in line. I had the line like down the street into another. It was, so when we turned it on, the cap at the time was $1,070,000. We raised that in 34 days, and it cost us about $23,000. So that was pretty good. And I was like, let's do this again, because it was like a 66% or thereabouts ROAS. Those days are kind of gone. But the reality is that the ones we see now, it's not like one thing that does it. It's like all the things. I liken it to like an orchestra. You need all the sections playing to hear beautiful music. Meta might just be the drum beat, right? But the reality is, it's like you have to invest in this thing too. The marketing of it. EnergyX didn't raise $90 million without spending some money. They spent millions of dollars, but the return and the efficiency of capital was there. And a large part because of the great technology that DealMaker has and a lot of other platforms has as well.
Thank you.
I think we have one more question after this.
So I'm big on analogies and things, and people remember the movie Gladiator, and he goes into the tent, and he says, Richard Harris says, Maximus, I want you to take over the Republic. And he's like, I can't do it, but he has the army, he commands the army. And this is kind of leading towards crowdfunding in the fact that if you can command that army and cultivate that army, you can lead. I mean, you're not only just bringing in the funds to build your business, but you're creating a loyal army that are going to run out there to the supermarkets and the bar rooms and whatever space you're in. And that's where I see the beauty of the crowdfunding, because you're hitting on all different cylinders of growing your company, the brand, the marketing of it, and ultimately gaining the capital you need to grow the brand even further. My question is the fact that how do you, where does the equity part of it, of the crowdfunding, take part? Like, I know there's non-equity and then there is equity. Where do you find that balance to what you can get away with to then position it, to your...
In terms of valuation?
Valuation and how much you give up. Like you said, with your PC that came in, what do we do with this army, right? How much, what's that balance?
I mean, I think deal by deal. And to your point, the reason why we called our company Maverick Brands is, if you have the waves that are hard to, the Maverick waves out in California, but also a horse you can't put a saddle on. So those brands that are fighting against convention, that are a David and Goliath that otherwise wouldn't be able to get to where they want to go. That's why we named Maverick Brands Maverick Brands. But to your point, every deal is different. We actually now structure deals that, what we talk about with founders is, what do you want to get out of this? You have to really look 5 and 10 years down the road. Is it raising on equity? Is it straight equity, or is it a convertible note or a safe? I mean, there's so many different ways to structure a deal. Why I'm a huge proponent is because the founder and the board can get together and really craft something that is tailor-made for the journey they're going on. It's like, what are we going to put on this ship before we go where we're trying to get to our destination? And part of that is how you structure the deal. I'm a huge fan of convertible notes, particularly with valuations being a little dicey in the space. You can kick the valuation down the road, and it's a good way for investors to clip a coupon, along the way.
Can I just add that, crowdfunding is a double-edged sword, because you see the Gladiator movie of the thousands of people doing your bidding. The reality is they put $500 in, and a little while later, they've invested in other beer brands as well. But the problem is VCs know the power law of fundraising. They know that things don't work out, and they take that into account. But when you've got retail investors, they don't understand this. My value has gone down. I want my money back. Dude, you can't have your money back. That was the whole point of the convertible note or a safe. So, if business is going brilliantly, the crowd's on your side. If business is not, it might be a tough crowd.
Yeah, adding to that a little bit too, if you take VC money and fail, you're letting down VCs, so no one's going to cry. But I think if you take crowdfunding money, to this point, you're losing money of people who might not be professional investors. You're not losing money from an endowment or a massive institution. You're losing people's money, and that can be, I think, heavy on a founder.
Okay, I have one question for John, since he hasn't answered any questions today.
I was avoiding them.
I know. So, as the chief marketing officer at DealMaker, you've seen the evolution of how marketing deals, how it can be the make or break between a successful campaign. What do you think, or in your experience when you were actually not on the DealMaker side, but helping issuers raise capital, what do you think was the formula for success for raising capital with marketing?
I'll take that one. Yeah, the marketing aspect's really interesting, right? Like, I think about distribution a lot. You know, distribution has changed, right? You know, it used to just be newspapers, and then it was social media, and then you have like Mr. Beast and Kim K. It's like, yeah, they own the distribution now. Like, they have that power. And digital capital raising is very much the same, right? It's like, you know, if you were going to reinvent raising capital today, you'd for sure use the internet, right? So, you know, I love that brands have taken what was purely an e-commerce tactic, like, you know, how do you grow your business online, to how do you raise capital online. And some of the tenets of what we see be successful in the space are things that are visual and visceral and in the zeitgeist, right? It's, you know, part of EnergyX's success is, you know, everybody got to hear about lithium and the clean tech revolution. Nobody got to invest in it, right? And then they hear about EnergyX and they say, oh, you know, this could be the next Tesla. I want to invest in that. So some of those things that we see there are really just retail investor appetite affecting or reflecting what I think is the lack of access to those private investment opportunities, where then that comes around and they say, oh, I saw, you know, this company that looks like Palantir, and Palantir does this. I didn't get access to Palantir. So really around the democratization of that and giving everybody access to it. So yeah, those companies that are leading the charge, right? You know, that retail appetite shows its interest in those companies that are the next change makers in those spaces. So, you know, companies that are innovative and visual and visceral, you know, that's one shade. But you know, you look at what Scott did at Island Brands. It's, you know, people also want to own the companies they love, right? Like, there's a reason that Reddit, you know, before their IPO, gave their power users, you know, stock, right? It's like they recognize that your brand strategy is now your capital strategy, right? And I think we're going to see a lot more of that, where people want to have a one-to-one relationship with the brands that they love. So yeah, really two answers there. That sort of like brand aspect to it too, but also this world of like, oh, I never had access to this private investment opportunity, and now I do.
Great. I have time for one more question. Does anyone have one more question for the group?
I have a double question. How does DealMaker decide which companies they want to work with? And then how do investors decide which platform do they want to use?
Good question. Yeah, we think about that a lot. You know, VC's role is to pick winners, right? That's really hard to do, right? That's why they have portfolio theory, and you know, they invest in a lot of companies. Our job is to provide the infrastructure for companies to raise capital. What we try to bolt on top of that is an analysis of, you know, your likelihood for a successful outcome and what that outcome may look like for you, really in terms of cost of capital. One of those factors Anthony mentioned is that social following, right? So when we think about somebody turning their community into investors, right? Obviously, a big social following is a component of that, but we look at sort of an aggregate of data points. What industry are they in? You know, what stage is the company at? What is their following like? And see if it matches any of the companies that we've been successful with in the past, and say, you know, hey, we can't guarantee anything, of course, but like, we think you fit in sort of like this tier of that. And we try to take that really seriously, right? Yeah.
Do you want to answer the second half of
We've you know, we used to take a lot of different companies on, and unfortunately, not every founder is going to be as energetic or exciting. You know, we actually Maverick Brands developed a very structured process now that we go through, and you know, it's really now become more quality over quantity. You know, I'm personally connected to the founders, and I don't want to let a founder down. So I've had tough conversations with founders where, you know, just give them my true, like maybe wait, fix this and do some of these things and come back, because sometimes even companies aren't ready for crowdfunding, and you really kind of get one shot, and the earned media and their stage, in growth, the reach. There's so many factors that we take into account, and we've leveled up now over the last year that we've had Maverick Brands. Happy to say that this now crop of 8 that we have launching on. We're platform agnostic, so we launch on various platforms. We're really excited about all of them because they all have, I think, that X factor that Energy X has that could go the distance. And we really look at now companies that we want to bring through the Reg CF and then graduate them to a Reg A. That's kind of more our focus now, is not really, now it's become more bifurcated. WeFunder's a platform that's like a public pool. All you have to do is show up. As long as you have a bathing suit on, you don't even need a towel, but you get one shot at it. And I'm not sure, there's Charlemans out there still, that are taking advantage of the situation, which is not necessarily who you want to work with in that space. So we've taken a much more disciplined, structured approach, and we're excited about the future of some of these brands that we believe are going to scale and thrive, and then we can hand them off to Will to blow them up even further and sell them.
I think if you look at the ecosystem, you've obviously got investors who are going to pick for themselves the right companies, the right stage to fit their investment thesis, and they might pick 1 in 100 that come their way because tons of coming in. And then you've got the matchmakers, the people who are helping you get your pitch in front of investors and finding investors and connecting you. But they want to have a decent batting average, otherwise it's not good for them and it's not good for you and not good for the investors. So they're going to do some picking. And then, on my side, I'm here to do the legals, but my goal is not just to do legals, which is boring, it's to help everyone get investment ready so you have the best pitch deck and the best opportunity to go and put a great pitch in front of people, so that whether you find investors yourself or you go to somebody to help you do that, you're going to have a winning pitch and legals.
I think we're done.
We took it to OT there. Thank you guys very much. That was a lot of fun. Appreciate it.
Thanks, John.